Hello and welcome to another episode of the Ideal Investor Show Season 2, where we bring you interesting guests and also have some solo episodes. And today we have a great guest. It's Dave Wolcott with us today. Welcome, Dave.
How you doing, Axel? Great to be here and connect with you and your audience.
Yeah, thank you so much for making the time. So before we dive into what all the things are that you're launching right now, tell us a little bit, how did you get into what you're doing right now?
Yeah, sure. My background is probably like a lot of your listeners out there. I was raised in a middle-class family in Connecticut, and I was told that the recipe for success was to go to school, get good grades, and then you're going to get a job and, everything would work out for you. So I kind of followed down that path and had the opportunity to do the ROTC program and join the Marine Corps after college. And the Marine Corps was an amazing experience. I got to travel the world, actually, work with some international folks in different places around the world. And we learned things that I think they don't teach you in academia or other places, things such as, leadership, teamwork, and integrity, right? So that was a really great experience. And then after that, I transitioned into the corporate world and got into the tech industry. And I quickly got kind of frustrated getting into that corporate machine. I lost that sense of purpose that I had in the Marines, that sense of impact, wasn't really there. Everyone was just kind of trying to get ahead. So I was a little bit frustrated. And then at the same time, my wife and I started raising a family. We actually had an 18-month-old toddler. And then, Axel, on October 24th, 2000, we literally hit the baby lottery, and my wife and I had triplets.
Oh, wow.
So, it completely, changed our lives and by quadrupling the size of our family. But the main thing that I was really trying to figure out at that point was wow, how am I going to provide for financial security for my family? So I went to see my financial advisor the next day, and he told me the same thing that they all say, which is, oh, just max out your 401k. You could do 529 plans for the kids. And, oh, by the way, the number that you have to get to, just grew by 3-4 times, right? So this really frustrated me. And I think the entrepreneur in me really wanted to solve the problem of how are the top 1% really building their wealth? So I then started investing in alternative assets, everything from oil and gas to raw land to, multifamily, all kinds of different asset classes. And then also, if you remember back to cash flow quadrant, right, from Kiyosaki, I moved to become a business owner as well. And so started, running businesses and learned a lot about taxes there. And fast forward 20 years, and I've really encapsulated all of those learnings in my experience in my book, which we call The Holistic Wealth Strategy. And it is all about creating this comprehensive wealth strategy and really have kind of a roadmap to building real legacy wealth, unlike, what Wall Street is preaching.
Okay, yeah, awesome summary. Thank you so much, Dave. Now, I'm sure there's plenty of details and all kinds of amazing stuff in the book, but can you kind of maybe give a little bit a high-level summary of what are the main components, main things that you have learned over the years?
Yeah, absolutely, Axel. So, I can walk through it kind of simplistically. There's really 5 phases, simple phases to the holistic wealth strategy. And that's all really underpinned by creating a vision statement. Okay. I find that way too many times people just don't spend enough time actually creating a vision of their life for themselves and their family and what they're really looking to achieve. So this is really critical to get clarity on that, because if you don't have a target, you're going to miss every time, right?
Yeah,
so really,
awesome that you say that, because a term that we're using, and it was originally coined by Brandon Bouchard, he calls it a BHAG, or a big, hairy, audacious goal, which is kind of similar to that. And obviously you have sub goals and sub goals and stuff like that, but I think we're very well aligned. That vision, or really something that is amazing to aspire to, is very important. So, okay, what's the next one?
Absolutely. So then you move into phase 1, and phase 1 is really, it's all about mindset. right? When I kind of got into this space, I've always been going against the grain. There's the 95% of the rest of the people are saying, just put your money in the stock market, give it to your financial advisor. So you actually have to have a growth mindset, right? To be able to think about things differently and be open to new ideas. You have to be a lifelong learner. I heard a good expression the other day. You have to be a learn-it-all versus a know-it-all. Right. And
yeah, that's a good one. I don't know if you know, but there's actually literally a guy on YouTube who calls himself Dr. Know-It-All. So
okay.
That's kind of funny, but no, I agree with that. Actually, we have such beautiful alignment because I had similar experiences and felt that it is important enough to create something I call the mindset manual that people can download for free. But I'm kind of curious. You said, you need to and work your way into a growth mindset. I have kind of like a name or a term for the other end of the spectrum. What's your discovery where most people start, or what do most people find themselves in?
Well, I think it's interesting, right? Because again, you have to understand that, the financial services industry is, made up of $30 trillion, right? So they want you to think a certain way, and they have an agenda, and so does your financial planner. So in order to break out of that, you have to have an open mind. And that's when I started kind of getting into the space and learning about, wow, there's all these other opportunities that I can get better results. I can actually reduce my risk and things like that. But I think, the growth mindset is really good. And then also, speaking of Brendon Burchard, I mean, his book, the, Success Habits is such an awesome book. And part of this is creating goals, right, that align to your vision. And then you can create goals, and then you can have habits that actually support those goals, right?
Yeah, I totally
that's crucial.
Yeah, absolutely. And I really think that is perfect. What I have discovered, and why, like the manual that I mentioned, is I think the financial industry that you just mentioned, as big as it is, would ideally love to have everybody exist in a victim mindset rather than a growth mindset. So I think you and I are both, together with many other people, preaching to get away from that. Don't let external circumstances be the driving force of your life, and rather, like you said, be open-minded, be active, be motivated, be goal-oriented, that kind of stuff. Okay, so you said that is, I think you said phase one,
phase
right?
one. Yeah, that's phase one. So, once you have kind of an open mindset and everything, and you're starting to create good goals, we move into phase two, which is all about increasing your IQ in multiple different dimensions. So we talk about financial IQ, obviously learning about, the alternative investment space, real estate, private assets. Some of these things are really important to know what's available. Constantly working on your mindset, right? This is an evolutionary trajectory that you never reach some kind of peak. You're always kind of trying to improve that. And then we also believe that health is so important, Axel, right? Because, think about Steve Jobs, right? I mean, he had, he's one of the wealthiest guys in the world, and he could not solve his health problems, right? And oftentimes, a lot of people, it's just this grind to get more, in corporate America or in life. But a lot of people really sacrifice their health to achieve wealth, right? So it's very important to, reverse that and think that you are actually your greatest asset. So if I invest in myself, if I invest in my health, I've always seen at least a 10x return on that. So continually, focusing on health. And then the last dimension I think that's crucial as well is your relationship IQ, right? So, it's Jim Rohn talks about it all the time, right? You're a product of the 5 people that you spend most of your time with. So who are those people getting you closer to your goals or actually taking you backwards?
Yeah, I'm totally with you on that. And actually, this statement around the 5 people you surround yourself with, I actually oftentimes like to separate that because, as you said, there's a social component, which I think is important to be inspiring and motivating and all those kind of things. But I think there's a second set of people in the context of increasing the IQ, like you call it, where you look, are you basically pulling the other 5 people that you're mainly spending time with to where you are? Or are you basically the one who is being pulled by the people that you spend time with in this increase my IQ approach. And if you're in the middle, I think that's still okay. But if you find that the people you spend most of the time with, they would love to be like you and know what you know rather than the other way around, then maybe it's not the best 5 people. And it doesn't mean you can't be friends with them. You might just not spend all or most of your time with them, right? So great. So, okay, we got that one. So we're building our IQ. What's after that?
Yep. So then we move into phase 3. And here you want to actually work on building an infrastructure around your wealth, right? And part of this focuses on the fact that you want to focus on your top 3 biggest wealth destroyers, right? So oftentimes all we're thinking about is the ROI in our top line. What type of return yield can I get for something? But if you can actually mitigate some of the top 3 wealth destroyers that are out there, that can provide, a significant, current, right, to your trajectory. So the first one being taxes. I've got so many scars from this one after running businesses for 20 years. I kept paying more and more taxes. The more successful you get, the more you pay in taxes, and was constantly blindsided until I really made that entire paradigm shift to understand that taxes are actually a series of incentives for business owners and investors. And when you can actually align to that and then start changing your activities, so you're investing in things like real estate or oil and gas, let's say, you're going to get really good tax benefits. And if you could just think about it. If you could get a 10 to 15% reduction in your taxes, plus you're getting, say, a 15, 20% return on your investment, now you've actually just, doubled the output, right, of what you can get. So that's, having a proactive tax strategy is absolutely key. We also talk about, protecting your wealth is super important as well. It's not only multiplying your wealth, it's protecting your wealth. So making sure you're doing the right things around kind of estate planning, asset protection, and then also to solve the liquidity challenge. I've been a huge proponent of the infinite banking concept, right, which is a cash value whole life insurance policy. Probably, I'm sure your audience is somewhat familiar with. And I've been using this with my wife for the past 10 years. And now we're helping our clients with that because, it creates a liquidity solution where you can put, cash, you can accumulate cash into this policy, and then it's compounding completely tax-free. You can give it to your heirs tax-free. It's got asset protection component to it. But the best thing is it's got this liquidity, like you can borrow against it. So we've now just witnessed these bank failures, and I think there's actually more to come. But when you, work with a mutual insurance company that's been around for 150 years, they're very solvent. And, putting your capital here is a great place to manage your dry powder for new opportunities, as well as, your cash reserves.
Yeah, and I think I want to touch on some of the things you just mentioned there a little more. For one, totally with you, and we are encouraging our clients also to do the velocity of money kind of approach. One of the things that I like about the whole life insurance component, besides never knowing what might hit you, like I always talk about being run over by a bus that you never saw coming. But the other thing is that can actually start while you're working your way to what you have been describing, phase 1, 2, 3. And it's kind of hard to say how long is the phases and can they happen in parallel or not, because the starting position, in my experience, is very different from person to person. But while you're doing it, anybody can determine, okay, and if they follow like the richest man of Babylon idea to say at least 10% of my income goes out of the income before I even get my pause on it, and put that into the whole life insurance policy while you're in the process of increasing your IQ and getting the other things in line. By the time you're then ready to really start investing, you would have something there already, right? Because I've seen several times, like some of my clients say, okay, I got this money in the 401k. I was stupid. I admit it. I want to change it. Can I just take it and put it in whole life? And yeah, you could, but you basically get a that way, if you were to put it in while you're in these other 2 phases, or maybe even while you're in phase 3, I think would be a really smart thing to do. So thanks for pointing that out. So what comes after that?
Yeah, no, the great points, Axel. And, another way to kind of think about this is, right, every time you deploy, even $1 of capital, right, it's so precious, your capital. So how can we get it to do multiple things at the same time? Right. And that's how, the ultra wealthy, right, have been doing things for many, many years, right? This is not new to them. So that's why that life insurance strategy is good, because you're doing so many different things with the same dollar. So after you've built up your infrastructure, we move into phase 4, which we call asset repositioning. Because a lot of people will say, hey, this is really good. I've got an open mind. I'm starting to create this infrastructure, but, I don't have cash to go invest in that next deal. Well, let's look at your portfolio allocation today. And likely, 90% of Americans today really have their capital in 2 different places. One is in their primary residence, which is trapped equity in their primary residence, earning a return of 0 on that. So you could simply take out, a home equity line of credit, even at today's rates at 6%. I mean, if I can borrow money from the bank at 6%, I'll do that all day long and get a 20% return on some of our private equity opportunities. And then in addition to that, you're getting more mortgage interest that you can reduce your taxes, right? So again, it's that kind of that multiplier effect, and looking at how can you reposition, capital that you already have. So that's one big place. And then the other big place, Axel, is, government sponsored qualified plans, 401ks, IRAs. And we actually built a 401k calculator. And I went through this process actually myself about 8 years ago, when I said, I had enough of waking up in the morning and saying something happened in China overnight, so your portfolio's down 5%, no control, no nothing, can't access the funds till you're 59 and a half. They tell you how much you can take out. Well, we created a 401k exit calculator, right? And this, I'll give a quick example to the audience, right, which is really illuminating, and I went through this process myself, right, which is, let's just say you had 100K in the 401k. And we'll compare that to compounding it out 20 years, leaving it in the 401k, versus what if you sold it today? Because they make us think, oh no, you can't pay the penalty. You wouldn't want to pay that penalty. Well, if you take the 100K, you pay the penalty, 10%, 10,000. Let's assume you're in a 35% tax bracket, so 35,000. So you have a net investable 55K. If you invested that into, let's say, a conservative, real estate multifamily syndication that's yielding 20% return, and you compound that out, and the income off of that is actually tax-free, right? Because you're able to depreciate your income there. And so if you compound that over 20 years, where you end up is over 2 million with that 55K. And if you left it in the 401k, net of taxes, the amount comes to 250K. And this is exactly why we have a crisis in this country. And this is why the rich get richer and the poor get poorer, right? It's because of the education and understanding these concepts, right? And I think financial planners are doing a real disservice, right, to people, that they're not educating, their clients on the fact that, you're going to have to pay taxes. You keep deferring all these taxes. I'd rather pay taxes on the seed and rather than the harvest. Yeah.
The other part, Dave, that I always point out is, if you say, okay, 2023, let's look at 2043. I'm really hard pressed to find anybody that has the IQ that you were pointing out to make a credible calculation that in 2043 taxes will be lower than today.
Exactly.
Right? So yeah, you're assuming when you say, okay, it's after taxes it's 250, but that's assuming today's tax. Right? If you look at all the circumstances around it, I think it's highly likely. I'm not a prognosticator or anything like that, but just looking at all the circumstances, all the debt and so forth, the aging of the population, you name all these different things that play a role, it is way more likely, in my view, that the taxes will be higher in 20 years than being lower or equal than what they are today. So it actually means, you'd be preferring to pay higher taxes most likely than what you would pay now. So I just wanted to point that out, because I think it's important for those who think, but I'm not paying it now, but you might be paying more later, so that's not necessarily the thing. And having a calculator, great. So if we now did that one, so I guess we're getting to page 5 now.
Yeah, so the last one is the fun one, right? It's all about taking action, right? And building massive passive income is what we talk about. So we like to invest, after 20 years of really kind of, honed in on our investment thesis, which is really, multi-dimensional. I call it kind of the trifecta of investing. Because if you have, let's say you have $1,000 worth of Tesla stock, the only thing that you're hoping for, Axel, is this for it to go up in value. But in reality, it can go sideways, it can go down. It's very one-dimensional in nature. Well, if you invest in something like commercial real estate, for instance, right, we're looking at this asset class that's got tax efficiency to it. It's got predictable passive income, and then it's also got a forced appreciation component where you can drive value into the asset and, improve its value and get, some equity upside on the back end, right? So in this way, you're able to actually, kind of, I think, reduce your downside risk, right? Because you can win 3 different ways. And you can also increase, your upside. We actually have an oil and gas fund where 100% of your investment is completely tax deductible against active income. So all those high income W-2 earners, right, you can actually completely, we've had some people bring their tax bracket down to 0 based on their investment, right? And then you've got double digit cash flow on top of that, and you've got appreciation gains, right? So that's really part of the strategy of the 3-dimensional investing. And then we also look at asset classes that are non-correlated to the market, and then are also low risk. If you think back to the days of Maslow's hierarchy of needs, right? And at the base layer, you've got things like, food, shelter, energy, right? These things that are always in demand. So we like to invest in, real estate, energy, things that people need. People always need a place to live, even if the economy is going down. On the energy side, I don't care what country you live in, what industry you're in or anything, the demand for energy is just continues to increase, right?
Yeah, especially if we go through this electrification, which from a climate perspective, I guess we kind of forced to ultimately. And I've always thought, and maybe a slight philosophical touch on this, the most joy, because you said now we're getting in phase 5, I have found that when you meet people in sunshine or by the beach in the sun, they're in the best mood, right? So why am I saying this? We have this energy engine sitting in the sky that makes us happy, that makes everything grow, everything live, right? And so for me, it's totally understandable. Yes, we needed to develop the technology, but I can only see that human beings will get better and better with solar, and will get better and better with batteries. And then there is no need to use anything else than the big light bulb in the sky that has been put there a long time ago, and that will be there probably longer than humans will be on this planet, right? So that to me is a completely logical progression to, where we're going to go. And like you said, if we can convert more and more of that energy, then more and more people will actually live a better life. So I think that totally makes sense. There are actually people, since you mentioned Tesla, and I'm kind of like a Tesla fanboy, who say everybody looks at it like a car company, but in reality, it's an energy. It's just not as far developed in energy yet as it is with cars. But I have that as my only stock because it's part of the fun.
Sure.
So I'm totally with you. Now, one of the things, because I said in the intro, this is part of season 2, you're a very experienced advisor, and you and I are very aligned in what you're doing. Actually, but I wanted to say one other quick comment. You mentioned in some cases you get people to basically a 0 tax bracket. I actually did that once, and then I wanted to invest in a property, and I couldn't get any funding other than from hard money because the lenders, or the traditional lenders, the banks and all the other ones that are out there, said, "You have no income." I said, "No, I have no taxes." But there's a difference, but for them it didn't make any difference. If your tax return doesn't say something like at least 80,000 or so, you can't get lending unless you found a way to build up your company's credit score, which is doable but not very easy and takes a long time. But I thought that was funny because I had pushed my CPA, get my taxes down, and then 1 year later, the bank said, yeah, well, you have no income, so you can't do anything. So
that's the only downside. Yeah.
I mean, what I learned, it's like you said, we need to build our IQ. I think I was a little overzealous, so I found out there is a balancing point where you say, okay, I should have at least a little bit of taxable income, so I'm still financeable, so to speak. But what I wanted to get on is, like I said, this is season 2. The main, overarching topic of our episodes right now is generating cash flow, and you beautifully laid out how to do this. But I think what people also realize is we have pretty high inflation. We have very high volatility in markets. You mentioned commercial real estate. There's quite a bit of news out there that due to work from home, high vacancy rates in certain metropolitan areas. How do you, for our audience who is kind of like, okay, I like these 5 phases, I would like to get into this, but how do I deal with all these things in these much more volatile markets since basically the Fed started increasing interest rates?
Yeah, sure. I mean, in terms of the volatility and the uncertainty in the market, I mean, that's why I like to really think about, again, the cash value whole life insurance policy as really kind of the bedrock to your portfolio, right? Because this takes all that uncertainty. They've been operating since the 1800s, right? And they've never missed dividend payments since then. They've been through countless recessions, depressions, you name it, right? So you can get just about a 6% return that's, accruing cash, compounding, right, tax-free, which I think is really huge, right? So that's where, I manage my, sleep at night capital, and then I also save up capital for that next opportunity. Now in the market, right, I think there's going to be, with uncertainty comes opportunity, right? So I think the next, 12 to 18 months, there's going to be some phenomenal opportunities in the market, in real estate, other, different asset classes. So, we have our ears peeled to the ground. I mean, one such opportunity, in talking about, passive income, right, and cash flow is, we're just putting out an opportunity to our investors that actually, some big hedge funds have access to this, but we got some exclusive access as well. It's actually in the merchant cash advance business. So we're going to take advantage of the fact that, small businesses, right, and all of these bank failures that are happening, small businesses aren't going to be able to get loans like how they were traditionally, right? So, and think about it, right? So, I live in Florida. We just had like a hurricane in October, right? If you were an uninsured business, or you could even think about it the opposite way, the roofing businesses were, 20 times, their revenue, right, that year, but they need to buy materials. They need to bring in, temp labor, all that kind of stuff. How can they get funding within a few days? Well, we provide that funding within a very short time period. And so it's private lending platform. And then they start to pay back principal and interest on a daily, weekly basis at, pretty substantial interest rates. So therefore, you're turning capital really quickly. And every time the capital comes back, it actually gets redeployed onto another loan, right? So you add on top of it a lot of velocity and compounding to that. So that's a good example of an opportunity that we're just bringing out to our investors right now. Super strong cash flow, and really taking advantage of the market dynamics right now.
Okay, that's very cool. One thing I'm kind of curious in that context is I believe there's plenty of evidence for it, that there's quite a substantial amount of zombies out there. Basically, for the audience, if you don't know what's considered a zombie or zombie company, is a company that is only able to survive when it can continue to basically borrow money for almost no interest. Right? I mean, I give one example that most people know by name. Is a company like Uber, right? Uber in its whole existence have never made a profit. And now they have Uber Eats and the Uber cars, but they've never really made a profit. And how can you run a business and never make a profit if you have access to money to investors in other places that give you the money for for almost zero or very low interest rate. But sooner or later, especially like I think you said, Dave, the money is not for very long. These are the kind of organizations, and not everybody needs to be as big as an Uber. It can be much, much smaller mom and pop kind of company. But there are, in my view, 25% at least zombie companies in the markets right now that are only still around after COVID, after everything we've been going through, because money was cheap. So, I think it's a great idea as long as there's some way to differentiate between those who are really good businesses, like that roofing business you mentioned. Obviously, when all the roofs fly away, then roofing business is king, right? And it doesn't take a brain surgeon to say, okay, that is a good business, especially if they have some history of running it well. But there are lots of other companies that are around there, I believe, that, wanted to do certain things, but never really proven that they are profitable. So I just want to say, it also still like always takes the IQ that you said, I think was in phase 2 or 3, to build and see how can I determine if a business is really a good business that I want to put my money in for good returns, like you said, versus a business that is only asking me for the money to survive another week or another month or something.
Yeah, sure. And I think, another way investors should really think about this, and that, that's why we created really a framework or this overall wealth strategy, right? Because it's all about making consistent progress, whether the market's going up or the market's going down, right? You have a lot of factors in play, and then that helps you, not to be over exuberant, when times are high, or, as we're leading into recessionary times, that, you make some kind of rash decision or something like that, because you have a very intentional strategy that's aligned to your vision statement, and you have goals that you're trying to get there, and then see how the opportunities fit into that, right? Because, you might be looking for something, maybe that's heavy cash flow. I'm looking for something that's more tax efficient, for instance, right? So really, I think, aligning, to your goals and vision is really important.
Yeah, absolutely. I think that's a great point. And the other part is, any of those kind of things that are a little bit more exotic, everybody has to decide while building and continuously improving that IQ, how much of my total distribution of assets and investments do I want to deliberately use, quote unquote, for playing, with yes, the opportunity to make maybe really big returns, but also knowing the risk that it might not happen. Like I, for example, would not be willing to do anything more than 10%, and 90% is very goal oriented, very much following the 5 phases you mentioned. But, if you want to have some fun, or if you think there is an opportunity to really get amazing results, it's a matter of how much or how little. I always say I personally couldn't be more than 10% and sleep well, but some other people can go a little further, as long as it's a measured approach on how much are you willing to play with for, the home run or the strikeouts. So I think that is acceptable as long as the vast majority of what you're doing is really in line with those phases that we have. Cool. So as we come to the end of the show, I always ask every guest that we have 2 questions that are not really directly related to our conversation. The first one is, if you could meet anybody past or present, who would it be and what?
Interesting question. Past or present as well. Yeah, I think I'd probably want to sit down with Elon Musk. He's just one of the best thinkers of our time. And especially around exponential thinking, right? The ideas that he's kind of coming up with, from an entrepreneurial perspective are just, really mind blowing, because I think most people think kind of in a linear fashion. And so, trying to think in that exponential fashion is really powerful. So that would probably be my choice.
Awesome. Yeah, I will come along if you let me on that one. Okay, great. And then the second and last question for today is, if you had a time machine, you're not allowed to change the time-space continuum, but you can go forward, backward, wherever you want to go, and you can see what's happening in that time, and everything now, where would you go in?
Actually, I mean, this is part of the incentive of why I wrote my book, Axel, right? Because, if I was talking to my younger self, in my 20s. I wish I had followed this wealth strategy. I mean, it took me, 20 years to really develop this, and I've got a lot of bruises, from going through it, and just having that knowledge would be so powerful. And my kids are in their 20s now today. So being able to kind of impart that wisdom as they kind of go through their journeys is really so powerful. So really, looking at this, strategy and everything, I think is really key.
Yeah, awesome. And I've thought about that myself a little bit, and I'm totally with you, because it's not even in many ways revolutionary if, like you and I and other people like us, had been pointed to the right places in the shelves in the library. And there's a guy like Dale Carnegie who wrote, I think, one of the profound books, like 80 years or 70 years ago or something like that. But if you didn't know that this was an important book to read, or, I mean, even Kiyosaki is now, 25 years ago or something like that. It's like, but we all cherish them when we found them. And I think the big point is, if somebody would have shown us where to go and what to read and then hopefully apply, it would have all gone a little faster. But on the other hand, there have been, I think it's good that people like you, Dave, and I are out there trying to help the rest of them, as many people as we can, to see it and find about it and learn about it sooner rather than later. Right? So
absolutely, this is really a passion project for me, and I think you hit the nail on the head. Is there's just frankly a lack of education, that's there. And Kiyosaki really started a massive movement towards, going against the grain and trying to think for yourself and learn some of these other concepts. And now there's great podcasts like this and so many other resources for people and future generations. So, I think there's definitely some opportunity.
Yeah, and I'm always flabbergasted because you mentioned education, right? Why is it that the reason, to me, it just blows me away, just as a quick anecdote. I always mention it, right? The reason that the way we are teaching kids today has been around this long is because there used to be a time when for most topics there was only one book, but there was no way to multiply thousands of books or stuff. There was one book. And you put that one big book that somebody had written and put pictures on and so forth on the lectern. And then you had the one guy who could read that book and interpret that book's lecture. If you really think about today, anybody who is now reaching 5, 6, 7, 8 years old, they're going to go to school, and it's basically still the same thing as if we had not progressed at all, right? And I think that's a little bit of shame that education in most cases is still being done like 500 years ago. So that leaves a place for us. So, we need to have purpose, right? So that's very good. Now, I know you said in the intro, before we started recording, you're launching a masterclass, you wrote the book and stuff. How can people get access to that, find out about it?
Yeah, really the best place, if people want to learn more about the wealth strategy, you can go to our website, pantheoninvest.com/wealth-strategy. And we have links to the book. You can buy it at Amazon or Barnes & Noble. It's on all the major retail outlets. We're trending actually at #1 in financial engineering right now on Amazon. So definitely encourage people to check that out. And then also, if you register for our book bonus materials, we've got the 401k exit calculator and some other, cool tools and resources.
Okay, awesome. Well, thank you so much, Dave, for coming, giving us the 5 phases and how we actually do it. And I'm always glad to have guests that are very aligned with what we're doing, because I think people need to understand this is the right way. And the more people we can reach, the more likely we will make a better future. So thank you for being here.
You bet, Axel. Grateful for the opportunity.
Okay. All right. Well, thank you, everybody, and catch you in the next one. Thanks for listening, and I hope you enjoyed today's episode of the Ideal Investor Show. More info and the links we mentioned during the show are in the show notes, or you can go to our website at idealwealthgrower.com and sign up for the Apple Podcast link. And if you like to talk to me, sign up for a strategy call. Hopefully you want to share what you learned with your network and bring more people in. We are really eager to hear your comments. And until next time, be well, stay safe, and ciao.